Most people think long-term investing fails because of bad stocks, or market crash, or not having enough money. But that's not what actually kills returns. There is a silent mistake almost every long-term investor makes. Smart people, disciplined people, even professionals. And the worst part, you usually don't realize the damages until years later when it's too late to fix. Today, I will show you what this mistake really is, what it quietly destroys, long-term wealth, and how to avoid using a simple proven approach. If you care about building wealth over decades, not chasing hype, this video will change how you invest forever. What most people think the mistake is. When people hear investing mistake, they usually think of things like picking the wrong stock, buying at the top, selling during a crash, not timing the market correctly. And yes, those can hurt. But here is the truth most investors don't want to hear. Those mistakes are loud. This one is silent. You don't feel it right away. There is no panic, no headline, no notification. Your portfolio may even look fine. But underneath, your long-term returns are slowly being drained. Number two, the silent mistake. The silent mistake killing long-term investing is inconsistency caused by emotional decision making, not fear alone, not greed alone, but changing your strategy every time the market, news, or emotions change. Most investors don't fail because they choose a bad plan. They fail because they never stick to one plan long enough for compounding to work. They buy when things feel safe, sell when things feel scary, pause investing during uncertainty, chase what worked last year. And every one of those small decisions quietly reduces long-term returns. Here is what makes this mistake deadly. Number one, compounding needs time and consistency. Compounding doesn't reward intelligence, it rewards patience and repetition. Missing just a few critical years or even months can cut your final wealth dramatically. Number two, the market rewards the uncomfortable. Historically, the best long term returns come from investing during uncertainty, during boredom, during times when confidence is low. But those are exactly the moments most people stop. Number three, emotions feel logical in the moment. Every emotional decision feels justified. I will wait until things stabilize. This time is different. I will get back in later. Later almost always costs more. Let's make this real. Two investors, same income, same investments. Investor A invests consistently every month, never stops during crashes, never tries to time the market. Investor B invests when things feel good, stops during downturns, tries to re-enter when confidence returns. Over 20 to 30 years, Investor A often ends up with hundreds of thousands, sometimes millions or more, not because they were smarter, because they were consistent. This mistake shows up in subtle ways. I will pause contributions for now. I will wait for confirmation. I will switch strategies. This one stopped working. I will just move to cash temporarily. Each decision seems small, but long-term investing isn't destroyed by one bad move. It's destroyed by many small interruptions. Here's how successful long-term investors protect themselves. Number one, use rules, not feelings. Decide in advance how often you invest, what you invest in, when you rebalance, and then remove emotion from the process. Number two, automate everything. Automatic contributions remove the biggest enemy, which is you. If money invests itself, fear doesn't get a vote. Number three, measure time in decades. Short-term noise disappears over long periods. The market doesn't reward reaction, it rewards endurance. Number four, accept boredom. The best investment strategies are boring. If your strategy constantly excites you, it's probably driven by emotion, not discipline. Long-term investing isn't about being right. It's about showing up consistently, ignoring unnecessary noise, letting time do the heavy lifting. The real skill isn't prediction, it's the staying. It's staying invested when it feels uncomfortable. If you remember one thing from this video, remember this. Wealth isn't built by avoiding every mistake. It's built by avoiding the one mistake that keep compounding from working. If this video helped you, give it a thumbs up and share it with someone who needs it to hear this. Subscribe for calm, long-term strategies that actually work. And in the comments, let me know what's the biggest emotional challenge you face as an investor.